Good morning, everyone. I hope you can all hear me.
Yeah, they can hear you, only that they have muted their sound.
Okay, fair enough. As long as you can confirm, you can hear, I think we can be able to start our discussion. Good morning, everyone. I trust you're well, and welcome to today's webinar discussion on life insurance and pensions. We shall be going through the full course in a summarized version. For those who are who are supposed to sit the exams previously, I hope you've been able to read, and as soon as we are back on, you should be able to do your exams. This training should enable you at least catch up and remind you of the concepts, but then also for those who are not sitting exams, who are trying to catch up in terms of knowledge, again, you're welcome to share, and we go straight. We shall use the first 1 hour for and about 20 minutes to do the discussion, but then later we shall give you a time to answer your questions and inquiries. Please, if you have inquiries, please send your inquiries to training department at iiu.ac.ug as advised by the IT administrator. Currently, all of you have been muted to avoid echoing, to ensure that we are all, to avoid feedback. And in case you have any inquiry, just send your inquiry on the comment section. The training department will be able to get your question, and then I'll be able to respond to the question later on. So, we shall begin a bit with a brief of the introduction to life assurance. And for starters, we should be able to achieve key 4 objectives here. We should be able to, 1, understand the definition of what life insurance is and what principles do guide the operations of life insurance. We should also be able to differentiate between life and general insurance. And then at the end of the period, we should also be able to substantiate and appreciate the role life insurance plays, especially to individuals, to the community, and also the country at large. I'll just give a brief description or a brief history for people who are maybe doing life insurance for the first time. Is that life insurance is technically not something new. It has existed for a long period of time. It goes back to periods as old as the Bible in the Roman Empire, whereby the Romans used the concept of contributions to help burial expenses. And as early as 1583, we had the first life insurance policy sold. We would say that life insurance was further guided and as per the Life Assurance Act of 1774, which introduced the element of insurable interest to avoid the aspect of gambling. In Africa, we would say life insurance has existed for a long period of time till today. In Africa, for example, we see that once we have lost a loved one, communities come together to be able to contribute to support the families. And then in Uganda, we could say the first company which began life was as early as 1996, which was National Insurance Corporation. And then in 1996, we had the Uganda Insurance Commission formed. And then today we are guided by the Insurance Act of 1774, by the Insurance Act of 2017, which is basically built on risk-based supervision that guides today the operations and modalities of the life insurance industry. In terms of definition, a life insurance is definitely a contract like all insurance policies. It's a contract, and we said earlier that a contract will always involve 2 parties. So you have the insurance company known as the insurer or the life insurance company, and then you also have the client or the life assured. So in this contract, usually there are 2 principal expectations. One is that as long as the insured or the life insured or the client pays the premium, the insurance company promises to pay a sum assured, especially upon the happening of a contingency. We say contingency, this contingency can be death, this contingency can be disability, and or if the insurance company, and then the assured is the person whose life has been best blessed. And finally, the assured basically is your age and the person who the life policy is based upon. And the proposer definitely is the person who applies for life insurance. What I would also want to talk about key is that the key main risks which form the foundation of life insurance, and there are basically three. The first being what we call a death. So we say that death will happen to all of us. We are immortal, and at one time someone will die. So that's a key risk which we can avoid or we can't run away from. The second aspect is what you call disability. Accidents happen and you can become totally disabled, and when you're totally disabled, it means you're unable to perform one, the occupation you used to do, but also two, what you are basically trained to do. So disability can happen. And definitely we age daily. We cannot forget about old age and retirement. So each year that we live, we are getting older and older, and the reality of life is that at one time we shall have reached an age that we're much older, and therefore these are key risks which build the foundation of life insurance. One being death, that death is real, that disability is real, but then also the worry of old age is also a critical component. To guide us further, it's also important that as we have understood the history of life insurance, but as we have also understood key definitions that guide life insurance, it guides us into also appreciating the principles that guide life assurance and its operations. Definitely, these are the same principles that also guide operations of insurance. We have about 7 principles that guide operations of the insurance industry, but only 3 do apply to life insurance, and that is basically insurable interest, we shall talk about utmost good faith, and then lastly, proximate cause. And then the other 4, that is subrogation, principle of contribution, the principle of loss minimization. Those do apply to general insurance. I'll dive straight to insurable interest. When we say insurable interest, is that it shouldn't be complicated. To make it us understand it better, is that insurable interest basically is the legal right to insure, one, that arises out of a financial relationship, and that financial relationship has to be recognized by law, and between one, the proposer or the person who applies for life insurance, or if in general insurance would be the insured, and the subject matter of insurance, whereby the proposer or the insured stands to gain, one, financially, especially if they're affected by the loss of the subject matter, or where they stand to lose if that subject matter is destroyed. If I give an example, is that if, for example, I'm a parent and I have a life insurance policy, you realize that my family would benefit from if tomorrow I passed away. So I will have insurable interest, one, in my own life. If in general insurance, a given example could be, for example, if you owned your car, you realize that if you lost your car, you realize that maybe you are depending on that car for your transport, or even for commercial, maybe viability activity. So if you lost that car, it means that subject matter has been destroyed, and therefore you lose financially. So that's what we call insurable interest. In life insurance, particularly, is also what we call the creditor-debtor relationship. And what we're saying is that a debtor has, the creditor-debtor relationship is a very special relationship. It happens so much with financial institutions, especially where we go to borrow money from financial institutions. So the financial institution is said to have insurable interest in your life. Why? Because if you passed away or you become disabled, you will not be able to meet your previous financial obligations that you had with the insurance company. So we say that the financial institution has insurable interest in your life. And the third part is that we also say couples also have unlimited insurable interest in each other, husband and spouse. And the reason behind that is that these people are assumed to be dependent on each other. The spouse is dependent on the husband, and then also the husband is dependent on the wife. So they also say to have unlimited insurable interest in themselves. So that is the first principle of insurable interest. The second principle is what you call utmost good faith, or what other people call oberimi fidel. So basically what talks about this looks into the aspect of disclosure. That's important that always, as we deal in insurance, as clients buy insurance, that we disclose all the information that will make the insurable company to be able to make a decision to cover that particular risk, even if it's general insurance, even if it's life insurance. So misrepresentation. So there are mainly two ways in which this is usually affected. The first way is what you call misrepresentation. I give wrong information purporting to be of myself. For example, in life insurance, I could say maybe I'm 30 years, yet indeed I'm 40. And you know very well that in life insurance is that it is priced in such a way that the older you get, the more costly the life insurance becomes. The reason is that as we age, the probability of dying gets higher. So if I price myself as someone who is 38, I'm 40, in this, what I'm basically doing, I'm making a misrepresentation to the company. The other example could be maybe giving wrong information about my medical history. Maybe I've had cancer, then I tell the insurance company that I've not had, I've suffered from another disease. So basically I'm misrepresenting the information. And that's important because the insurance company is deemed to rely on that information that you provide. And why? It's only you knows all that information about life. And if it's in general insurance, it's assumed that it's the client that knows all that information. And then the second aspect is what you call non-disclosure. Non-disclosure basically is you conceal information. If you look at this picture here, this is a very interesting cartoon. I look at two parties. Maybe one is the insurance company. Then one could be maybe the client. Each of them has a knife behind them and they're greeting each other, but all of them are concealing information. And in that, as we say that both parties should be able to provide that information to each other. But disclosure is not only the responsibility of the client or the insured, it's also the responsibility of the insurance company. The insurance company must be able to disclose full information to the client, especially the terms of the policy, the workability, the methodology of the policy, what is covered and what is also not covered. So disclosure is a two-way aspect. And finally, we talk about what you call proximate cause. Proximate cause, in simple terms, basically is a principle of insurance which tells us about what is the exact cause of the loss, what is the most influential factor that led to that loss. So there's a possibility that a loss could have been caused by various factors, but the question would be what would be the most influential factor that led to that claim? And that's what basically you call proximate cause. So the other four principles do not apply to life insurance. One is the principle of indemnity, and that applies possibly some insured of my car after the loss has occurred. And this cannot apply to life because one, life is irreplaceable, you cannot bring back life. But then in life, the quantum of insurance is already predetermined. Whereas in general, it's different. The probability, especially of partial losses, can never be predetermined. And that's why the principle of indemnity cannot apply to life insurance, but rather it will apply to general insurance. The other fifth principle is what's called the principle of subrogation. Principle of subrogation definitely only applies to also general insurance. Basically, what you are trying to say is that once a claim has occurred, especially involving third parties, the insured will give up their rights of any benefit to that policy to the insurance company. and the insurance company takes over those rights of pursuit of any benefits which was accrued to that policy. The other principle would be the principle of contribution, whereby you have a risk covered by more than one insured, and when a claim occurs, the different insurers are called to contribute based on the contributional rates which was pre-agreed before the policy was arranged. And then finally, there's what you call the principle also of loss minimization. So that in general insurance, if your house is burning, it's expected that you don't just see your house burning, you put efforts to reduce the loss, maybe by using a fire sprinkler or a water sprinkler, but efforts in trying to reduce the loss, which in life insurance definitely wouldn't apply. I'll touch briefly about the characteristics of life insurance. We have talked about some, is that they are usually long-term policies. And by long-term, basically we are saying that they're usually more than 12 months. Life policies are long-term. You find especially most run for 5 years, 10, but usually for a longer period of time. But general insurance is usually for short time, fixed for usually 1 year. The other aspect is that life insurance applies to human life, whereas general insurance would apply to liabilities, assets, and other risks. Life insurance basically would look at a human life. And I already talked about that life policies are non-indemnity policies. I already talked about that. But then also life policies can be assignable. When you talk about assigning policies, is that we say that we assign the benefit. There's no change in the risk or the assured, but we basically assign the benefit to another person. I'll maybe end basically here with the benefits of life insurance. Since this is an introduction, it's also important to us to appreciate the benefits of life insurance. The first one being that as an individual, life insurance provides a benefit of a peace of mind, knowing very well that in case something happened to you, the people you have left behind, you have the comfort and the peace of mind that their future is guaranteed, that their future is protected. So, and that is very critical. The other aspect is that life insurance, as an individual, life insurance also promotes savings. And the savings aspect comes especially after the end of these policies are usually long-term, and these policies run usually, let me say, for 5, 10. So if after 10 years, I've been putting aside this fixed amount of money periodically, at maturity of the policy, the sum assured is paid back to me with accrued bonuses. So you will use that money to be able to do some of the things which you had not earlier planned for, maybe to purchase a house, maybe to buy land. And in that way, it has acted as a savings vehicle. Of course, it also provides protection to our families. We usually say that if you're the main breadwinner of the family is so much dependent on you, because if you work, you take care of the expense of the family, maybe education of the family. So in this case, if anything happened to you, your family could be exposed. So life insurance comes with a very critical way of coming to protect the family. But then also to the financial industry and banks particularly, it helps protect especially mortgages and loans borrowed against the aspect of death and disability. If you borrowed money from the bank, assuming I borrowed money, let me say from Bank of Africa to finance my house, maybe house costed 200 million. Remember, I'd made a promise to the bank that I would be repaying money periodically. But the biggest risk is that I cannot control the risk of death. If I passed away tomorrow, or if I became permanently disabled, I will no longer be able to meet the obligations of the bank. And because I'm not able to meet the obligations, it would imply that property. This company will come and say, you will do is that you will tell the family alone the outstanding. In this case, led to cushion mortgage, and also aspects of business. We have seen partners and maybe capital injected to the business. The risk would be in case one particular partner to purchase what you call a term policy with up to a certain limit. And in case of death, of risk occurring, that sum assured is paid to the business. So the business is able to continue, but also helps especially in case they passed away, the business would struggle because of their dependency. So in this way, the policy helps to protect. But of course, finally, the worry of income at old age. Later, I'll be talking about what you call annuities. So annuities help us protect us, especially once we have retired and we're able to earn income even at old age, to guarantee what you call social security and increase longevity, especially as we live. So those are the benefits to you as an individual, but also to the community. One of the biggest burden we face is that when someone has passed away, there's a critical challenge of funeral expenses. So the burden of funeral expenses. This burden of funeral expenses can be covered, especially by life companies. So when someone has passed away, life companies contribute a funeral benefit, which is used to meet the expenses to do with treatment, for example, of the body from the hospital, treatment of the body, dressing of the body, announcements, for example, in the radio, announcements in the newspapers, transportation of the body to the burial ground, digging of the grave, taking care of the mourners. So this burden is taken off the community. And of course, the second one is in Africa and the world today, we have high dependency ratio. In Uganda, for example, we have a dependency ratio of 100%, which means to everyone who's employed, 100% has dependents, either could be children or an extended family who depend on their life. So dependency leads a lot to poverty, especially if someone passed away and they were the main breadwinner. Life insurance continues to make a benefit payable to this family. And since this benefit is payable to the family, it helps reduce poverty because you've taken away the burden of dependency of the community on this family. So like the company comes to make that substitution. And finally, also, not only is life insurance important to individuals, not only is it important to the community, but it's also important to the nation. To the nation, the premiums which companies collect, most of the premiums companies collect is invested, especially into security markets. Into bonds, into treasury bills, into deposits, fixed deposits, and this helps mobilize what you call savings. As you mobilize savings, government is able to borrow. Each time, for example, that companies invest in bonds, treasury bonds, corporate bonds, government is able to borrow and invest a lot of this money into infrastructure projects. You're seeing the roads, we're seeing a lot of infrastructure projects. So because of that, life insurance plays a critical role in mobilizing savings. The other aspect is employment. The insurance industry employs a lot of people. If you look at the technical people working in the industry, the people training in the industry, but also the people who market insurance products in the industry. It has offered a great opportunity of employment to the industry. And of course, tax. Companies pay corporation tax at the end of the year. And corporation tax at the end of the year, which is basically 30% of the income profits the companies have made, goes to the Uganda Revenue Authority. And that money goes a long way into contributing to the development of the country. Employees contribute to pay. We have withholding tax. A lot of taxation is paid by the industry. So that's a bit of the first part of my presentation, which basically was an introduction to life insurance. We're able to appreciate the history of life insurance. I think we're also able to appreciate what a life insurance product is. We appreciated also the principles upon which life insurance operates. And then finally, the benefits of life insurance. The next aspect we want to look into is what you call the law of agency, and then a little bit of marketing. We have understood what life insurance is. It's also paramount, it's also critical that we understand what you call the law of agency and how life insurance can be marketed, especially within the industry. So we shall appreciate here what takes place in what we call agent-principal relationship, responsibilities of each party and how it's created. And then also finally, we should be able to appreciate what you call the sales process, what makes us to be successful as sales people within the industry, or what can make companies to be able to sell insurance successfully within the industry. A little on the law of agency on that slide, I'll just comment briefly, is that the law of agency basically looks at what you call the principal-agent relationship. And the principal-agent relationship is a very important relationship in recognizing law. The principal, usually, if you look at our industries, that agents assume to act on behalf of the principal. So if, for example, I'm an agent of a life insurance company, assuming the life company is maybe UAP or Prudential, as an agent, I'm meant to act on behalf of the insurance company. And when I act on behalf of the insurance company, it means I have to obey I have to obey what my principal tells me, of course, if it's reasonable, but then also whatever I do to third parties, for example, as I service customers and other third parties, whatever I do binds the principal. So that's so important, especially in this relationship. So the principal, we have the principal, usually it's the insurance company, and then the agent usually is I could be the marketing person, but then also you could look at it in the other way. If you look at, for example, employment contracts, you have the employer and the employee. The employee is seen as an agent acting on behalf of the principal, who is the employer. Those are just two examples I wanted to pick it for you. These are important relationships also for us to appreciate, especially as we may come into the dealings within the industry. What is also important for us to appreciate is how is this relationship created, especially in law. This relationship can be created in about 4 ways. The first one is created by what you call an agreement. If I'm an agent, assuming I'm an agent of, for example, Prudential, an agreement will be given to me once I've been recruited, possibly to sell life policies on behalf of the company. And if I sell these life policies, I'm able to earn maybe a commission. Critical here is that an agreement will be given to me that speculates the terms and conditions of what will be expected of me, but then also what is expected of the insurance company. For example, one of the expectations could be that I must meet my targets, but then also the insurance company is expected also to make my payments or emoluments to me. If it's an employment relationship, it's expected that the employee performs his responsibilities, and then also the employer should be able to pay possibly salaries or bonuses or benefits to this employee at the end of the period. So that's the first way that relationship can be created. It's usually by agreement. And if it's an agreement, it's usually expressed. I mean, it's basically written down that you're meant to perform particular activities. The second case is what you call creation by necessity. This is a very interesting relationship. And the creation by necessity, sometimes you can be in a contract is created, especially due to maybe an emergency. There could be an emergency which needs in place, whereby you, the agent, will act. You may not have been appointed by the principal, but because of the emergency, it makes it deemed for you to take care of that emergency. Maybe I can give you an example. A common example would be, assuming you're a shop, maybe you provide services to customers who come to buy from you, and maybe these customers have left items at your place, and in this case it's necessary that you take responsibility of taking care of those items. You realize you didn't have any formal contract, but it was reasonable that you needed to take care of this item. The common example I give, for example, I see homes, and especially where people live in communities, a neighbor could have left clothes out, and maybe it's raining, and you feel it's necessary that I go and pick those clothes because it could rain on them. You see, in this case, you didn't have a contract to do it, but because of the emergency in that place, because of the emergency at that condition, it makes it necessary for you to take care of that item. By you doing that, ideally, you're forming a contract, and in this case, you're creating a relationship where you're binding the activities of that person. The third case is what you call ratification. Sometimes, especially, ratification happens so much whereby to the third party, they may not know, they could believe that you're an agent of acting on behalf of the principal. Assuming, for example, an agent, let me say of Jubilee, for example, and I could have left the company maybe to do other things. But to the third party who is the customer, the third party he still thinks I still work for Jubilee. And maybe today the customers may be standing order could have bounced. So the customer calls me, Joshua, please, come and pick the check or come and pick money for my premium. So if I went and picked the premium, to the third party does not know that maybe I've left Jubilee. So because he still thinks I work for Jubilee, I go and take the money. So, and then later Jubilee accepts what I've done by ratifying, for example, what I've done. Ratifying, which means the they recognize what I've done. It means basically they've ratified my work, and therefore a contract can be created. So that's what you call creation by ratification. Another example could be if I'm an agent, maybe I've been trained in life, and I went to prospect, and assuming I went to visit my customer, maybe who works at UBOS. And when I went to visit my customer, and I found maybe my customers were in a meeting, maybe a management meeting, and my customer gets excited. He says, Joshua, please come and talk to the staff. Remember, I was trained in life, but maybe I also have experience in selling general. So because I'm authorized only to sell life, but in this case, when during this management meeting, staff tell me, please, can you also talk about general and medical? And because I maybe I could have had past training in that, I'm able to talk about general and medical. And when I go back, remember I was not authorized to sell medical and general. But because of the circumstance I was in, after selling, going back to the company ratifies or agrees that what I said was true, especially how I sold it. It means they've actually ratified my actions, and therefore a contract is formed. And then finally, by law. This is so common, especially with partners, and you realize that partners and businesses are partners. A relationship usually created where partners assume to act on behalf of each other. Commonest example, look at advocate firms. You could have Joshua and James advocate firm. So Joshua and James assume to be partners acting on behalf of each other. So that is what you call creation of agency by law. So those are the four main ways in which this relationship can be created. One, by agreement; two, by necessity; by ratification; and then also by law. Definitely, because this relationship is a very critical relationship, both of us have a responsibility to play. And that responsibility, especially to the principal, both to the principal and then also to the agent. The agent, first of all, has to obey the principal. If I'm an agent of an insurance company, I'm meant to obey what my principal tells me, but then also I'm meant to act with care and skill. By acting with care and skill, and to perform, but then client gave me money. And do I take the standing order to the company, or I stay with it and the customer's debit passes away? If a customer gave me a check, do I have to take it to the company? If it's a claim, do I report the claim as it was occurred? That is that's being basically acting good faith, which we had earlier talked about. But no, there are also responsibilities of the principal. Much as the agent fulfills his principal, his duties, the principal is also expected to fulfill. For example, it's expected that if I sold my policy, I should be paid my commission. The insurance company should be able to pay your commission. But then also too, if there are certain expenses which you think you could have incurred, which should be reimbursed back, the insurance company also should be able to reimburse back those particular costs, especially which you incurred when you sold the policy. So definitely, I'll also comment briefly on what you call the authority. Of course, much as we have understood this relationship, we can need also to appreciate to what extent is the authority. So authority usually is in two ways. There's what you call actual authority, and then there's also what you call apparent authority. And actual authority definitely is the authority which you have expressly or explicitly or orally for you to sell. For example, if I've been given a contract by Prudential to sell, for example, life insurance, it would mean I have the authority to sell. I have actually actual authority, and that actual authority is basically written down, it's express. But then also it can be implied. The example I gave earlier of this agent who went to visit the customer at UBOS, and he was invited to sell, and because the circumstance he was in, he had to talk about medical and general insurance. So it was implied that to them, it was implied that he was still an agent of Jubilee who understood all these policies. So in that case, he had the authority to sell. But then the second case is what you call apparent authority. So actual authority can either be expressed or implied. Like I've said, actual, you have the actual authority either expressively or orally. But then can also be implied, like the case I've just given. But then the second case is what you call apparent. Apparent here is so much, especially whereby to the third party, who is usually the client, who was not part of this relationship of the insurance company and the agent. And you find that the third party does not know that either you still act on behalf of the company or you've left. If I gave an example that maybe I've left Jubilee and the customer called me to go and pick a check. When I ran to pick the check, when I went to pick the check, the customer gave me this check. So there's a possibility that I may not take the check or take the check to the company. That's another different case. But if, for example, the customer was not aware that I was not still working for the company and I used the money, you still realize that I still buying the principal. So if there's a claim, the insurance company still must be able to pay the claim. So that's what you call apparent authority. So to the third party, basically, they don't know that you still don't have authority, because possibly the company could have laid you off, but to them, they still think you still have authority by the company. Definitely, I'll also comment briefly on how this relationship comes to an end. Definitely, everything which starts definitely has to come to an end. And that's what you call termination of this contract. Now, termination of contract usually is classified legally into two ways. One, by acts of the parties, but then also two, by law. By acts of the parties, one, the same agreement that created this relationship can also cancel this relationship, can bring this relationship to an end. But then also two, there is also what you call by revocation. The principal can decide to take away the authority who had given the agent, maybe because of indiscipline. An agent sometimes could misappropriate premium, or maybe they've acted what you call beyond their powers, or you have done things which you are not meant to do. So I can withdraw that authority. But then also, there's what called renunciation. The agent could say, I'm tired. I just want to do something else. The agent says, I'm tired of this relationship, and maybe I'm going to pursue further things, and that relationship can come to an end. But then also, that is by acts of the people in that agreement. But also, too, by also operation of law. Legally, the law recognizes ways in which legal relationships can come to an end. The first one is what you call by death. If there's death, if death has occurred by one of the parties, definitely that relationship comes to an end. And death can usually be by, for example, if an agent has passed away, the relationship cannot exist. But then too, there's what you call insanity. If there's insanity by either of the parties, if one of the parties became insane, it means one, they no longer have what you call in law, the capacity to be able to enter into the contract. They're not in the best state of mind to be able to enter into a contract. So insanity also leads to a contract coming to an end. But then also there's what you call bankruptcy. Of course, bankruptcy, if the principal, for example, becomes bankrupt, it means basically they're no longer able to meet the expenses to all the creditors, to people who owed them. Definitely the company can't run, and therefore that relationship comes to an end. And then finally, by frustration. An example I give of frustration, assuming I'm a performing artist and maybe I have to go and perform in Gulu at a particular hotel. Just imagine a day before I go to perform, that hotel is burnt. So you realize there's been totally destruction of the place of where I was supposed to perform, or destruction of the subject matter. So in this case, that relationship definitely comes to an end. And the law recognizes, those are the four ways the law recognizes bringing contracts to an end. So we have at least been able to appreciate the law of agency, and that is basically understanding the agent-principal relationship, understanding the parties that participate or that come into this contract. We have been able to also understand the duties of the agent, the duties of the principal. Then also, what authority do they have? We have also been able to understand how that relationship can be terminated. And finally, I'll also comment briefly on marketing, a brief of the sales cycle. The fact that we sell insurance or provide a service, it's critical that we appreciate the sales cycle. And actually, it's a scientific model which companies can adopt, individuals can adopt to be able to sell or to perform better. So in the first sales cycle, the first thing we do is to prospect. When you're prospecting a client, it means you identify potential people who would be buyers of insurance, maybe from your contact list, maybe from the website, and maybe from newspapers, but you try to get a lot of information that you're able to prospect. But prospecting is just not enough. Number two is you need to approach that customer. Approaching, which means you make an appointment and you meet the customer and are able to, you hear from them. That leads us to the third aspect of what you call needs assessment. Often as marketers, we try to dump policies onto clients, but we should be able to do a needs assessment of customers, understand their needs, and we're able to provide that. That provides a listening arm. That brings the aspect of marketing of what we call being able to listen. And that's very important, especially if you're to become successful salespeople. If you listen to the customer, it means you've been able to now understand the need. And once I understand the customer's need, I can now present my solution. So I present my product, and that's important to the agent. Remember, you need to know, you have to act with duty and skill. You should have understood the operation of that policy. Then, of course, as I present to the customer, not all customers will buy. Some will reject. Some will say, I maybe don't have the money now. Maybe I don't need it now, maybe for tomorrow. Please don't get discouraged. Objections are normal in the marketing process. Some people give up, maybe say, I've had a bad day, but please don't give up. It's normal. It's a normal process of marketing. Then, of course, you should be able to close the sale. Closing the sale, as in life insurance, even in general, we say the client has paid the first premium. So we say policy commences after receipt of the first premium. And then later, don't just close the sale and leave. There's what you call after sale services. What I got to do to ensure this customer stays with you after. So that's a full sales cycle. So that's the conclusion about this sector chapter. We have understood law of agency. We have understood the principal relationship. We also understood creating of relationship. We've been able to appreciate our duties as agents or the principal. We have been able to appreciate the authority that we have, how this relationship also comes to an end, but then finally the sales cycle, what will make us successful people. The third chapter, or the third sector I want to discuss is what you call, since we have been able now to understand what life insurance is, we have also now been able to understand the legal systems involved in the operation of life insurance, especially the agent and the insurer. I think it's now fair enough that we now start appreciating life insurance products. And here we shall talk about the products, but then we shall also go briefly talking about key features of life products that exist in the market. So very first here is that to make it easier for us is that for you to, earlier we had said that we face three main risks in life. The first risk was death. The second risk was what you called disability. And the third risk was the worry of old age or worry of retirement. Now that helps guide us into classification of these policies. So life policies are classified usually into about three categories, but predominantly two are more pronounced, especially in our market, but in advanced markets is mainly into three. The first one being what you call savings products. And savings products, earlier we had said that life policies play a critical role into providing savings, especially long-term, that they act as a savings vehicle. And here we shall later talk about policies, what you call endowment policies in the next chapter. But then also too, there's what you call also protection policies. So protection policies are policies which are usually bought to protect us against the risk of death. So if nothing happens, if death does not occur, nothing becomes payable. And then finally, there's what you call investment products. Usually these are products, life policies that are linked to an investment arm, what you call unit-linked policies. Not so much common in our market, but in advanced market, you find that if you bought, for example, a life policy, it has an investment element. So that because of that investment element of the investments in what you call in unit trust, it brings what you call the classification of investment. So those are the main three ways in which they're classified. Of course, definitely key terms will also be critical. For example, what is premium? So premium is, we later said that life contract is basically life insurance is basically a contract where you have the insurance company and you have the client that comes to buy a policy whereby they pay a premium, and that premium is the money you pay periodically to protect you in case of risk. Now that risk which happens, we call it sum assured. And then later shall be talking about what you call maturity. When your policies reach the end of the period, we say our policies have matured, or they have expired. Some people say also expire, like term assurance policies are said to expire, whereas endowment policies are said to mature. Of course, after understanding the classification of savings, protection, and investments, that guides us also to appreciating a bit of the products. So when you talk about products, you'll find the key, there are about 4 or 5. The first one is what you call term assurance products. So term assurance products, I would classify it as a typical protection policy. So basically, it's a policy whereby which covers the life assured of the client, provided the risk occurs during the period of the policy. So if I buy a term assurance policy of 5 years, if the risk, or if I passed away during the 5 assured becomes payable. But if after 5 years nothing has happened, the policy just expires and nothing is payable. And term assurance policies are really very important policies. It's actually the traditional foundation of life insurance or policies, and it's typically applied especially within the financial sector, especially with loans. If someone borrows, for example, loans, if someone borrows mortgages, and in case remember they take a mortgage for a definite period of time, in case they passed away, the bank comes, the insurance company comes to pay the outstanding loan balance. So that's a typical application of a term assurance policy. Another example is also the group life policy. Later I'll be talking about group life assurance policies. An employer takes out a policy maybe for a fixed period, let me say 1 year. If this employer dies, if case this employee dies during that 1 year, a claim becomes payable. If nothing is payable, then the policy, nothing is payable at the end of the period. So that's the second applicability of term assurance. Of course, the other third one would be what you call in key man assurance policies, which I earlier talked about. It's also applied in that. So the second category is what you call whole life policies. A whole life policy, again, is a typical protection policy. And basically, these are policies taken to cover for the whole of life. So imagine, and people, a bit not so common in our market, but it's there, but a bit so common in the developed world, where I assume that at one time, I won't be there. So because I won't be there, I buy a whole life policy to cover me for the whole of life. And they typically, why people usually buy it is usually for two main reasons. One is for funeral expenses, knowing that at one time, if I passed away, who would cover my funeral expenses? But then also too for estate planning, knowing that if I'm a father, I have an estate, I'm a family, knowing that if tomorrow I passed away, what happens to my estate? So many people buy it also for estate planning. And then the third category is a bit common, is what as we call the savings policies, a bit of endowment. Of course, like I said earlier, traditionally, term and whole life were traditional policies. But because of the need, people would now give us a question. Remember, insurers continue to make products that meet the needs of our customers. If, for example, I did not pass away during the term, then what happens to the money? What happens to me? So that led into innovative ways in which the industry had to come out with innovative products to meet customer demands. So these are typically savings products. So very common in the market, you keep hearing about education plans, child education plans, very common. They're typically endowment policies. Other companies, for example, Jubilee has what you call the Kwanjula plan. It's a typically endowment policy for a fixed period of time to meet a particular need. So endowment policies are usually designed as savings policies to meet particular needs. If I have a need, assume I could have a need that in 5 years I want to buy land, in 5 years my child could be joining university, in 5 years I want to do this particular thing. So the savings policy can guide us, and the best would be an endowment policy, such that in case risk occurs during the term of the policy, the claim becomes payable. But if nothing occurs at maturity, I get back my money plus what you call bonuses. Later, I'll be talking about bonuses. And I'll also talk briefly about what you call riders. So insurance policies cover what you call riders. Riders are what you call additional benefits, or some people call it sweeteners. What makes an insurance policy more attractive? So there are few waivers. There are few riders that we have in insurance policies. The first is what you call waiver of premium. If, for example, I get permanently disabled, the insurance company will waive off the premium that I would have to continue paying, and the benefit of the policy would continue. There was what you call a double accident policy benefit. What happens here is that if, for example, I died as a result of an accident, the company would pay me twice the benefit. One would be the accidental death benefit, and then also the main benefit, making us what you call a double accident benefit. So here it's sort of to sweeten. And then there's also what's called the permanent disability rider, total permanent disability rider. What I'm trying to say, in case I get permanently disabled, a benefit can be paid extra to the policy. And then also it also continues to cover what called critical illnesses. Critical illnesses are basically diseases which are usually listed in the policy, whereby as long as the client is diagnosed as suffering, remember for the first time, you're diagnosed the first time as suffering from a disease that is covered in the policy goes to offer a benefit. Usually, this is called more of a terminal illness benefit. Ideally is that if, for example, I fall sick, must I wait till I die that the benefits only paid to my family? Can part of that money be used to maybe finance or my medical treatment. So that's what we call critical illness policies. The number of critical illness diseases, usually they are listed in the policy, but they could include typically things like cancer, things to do with heart attack, things to do with stroke, for example, things to do with paraplegia, things to do with maybe kidney transplant, things to do with organ transplant, things to do with mega organ transplant, liver failure, pulmonary artery disease, a number of critical illnesses. And then, of course, I talked about funeral expenses, which were basically last expenses, so which I'd already talked about. So usually the insurance company will charge an extra small premium. For example, if I was paying a premium of 100,000, they could charge me an extra 5,000 shillings to be able to pay for that rider. So basically, that's a summary of how these policies are classified. We've been able to appreciate the types, how they're classified into savings, protection, and investments. We're also able to appreciate key terms within life insurance. We appreciated the products to do with term, whole life endowments, but then also the riders that do apply to these policies. This will lead us to go deeper into endowment. What does endowment entail? If, for example, we say whole life, what does it entail? If we say, for example, term assurance, what does it? So we shall go a bit deeper here to appreciate these features of these policies. So I'll start first with a term assurance policy, which I've just talked about it. And the term assurance policy, like I defined, covers death occurring within the period of the policy. And term policy, there are a number of term assurance policies. There's what you call a level term policy. So a level term assurance policy is a type of a term assurance policy whereby the premiums remain fixed, they're level throughout the period of the policy. And it's quite common. And I would buy a term assurance policy with level premium fixed for the period. But the second one, there's also what you call increasing term assurance policy. This is so common, especially for people where you recognize that my income maybe periodically could grow, or possibly I could have gotten promotion after some time, and therefore have more and disposable income. So it helps me as a client to be able to grow my benefit, and that's what we call an increasing, so to recognize especially increase in salaries or maybe other source of income that I've earned. And there's also what we call a decreasing term. Decreasing term is so applicable so much to financial institutions, especially with loans. If I borrowed a loan from a bank of 10 million, assuming this loan is to run for 5 years, remember periodically I'm repaying the loan. So the sum assured, which means the outstanding loan balance, continues to reduce periodically. And in case of risk, I only pay, the bank comes to pay the outstanding loan balance based on an amortization, what you call a loan amortization schedule. So basically that's a decreasing term. It's called a decreasing term because the sum assured decreases, especially as the term increases with the policy. Of course, the other one we also have is what we call renewable term policy. A renewable term policy, basically the fact that term policies are fixed for particular periods of time, maybe 5 years, maybe 10. After 5 years, I don't need to take this client, subject me back, particular client back for medical. So the policy is renewed automatically. And then also finally, we end with convertible policies. Policies can be convertible from one type to another type. The second type is what you call a whole life. And like earlier I said, whole life policies covers for the whole of life. And whole life policies are classified into mainly two. There's what you call a with profit and then without profit policies. So with profits, these are typically policies whereby clients participate in the profitability of the company. So what happens is that at the end of the year, I'll be talking, late in the next chapter, I'll be talking about valuation of life funds. At the end of the year, life companies do what you call actuarial life valuation of the life fund, where basically they ascertain the excess of assets over liabilities to determine what you call the health or the health of this life fund. Is this life fund health, is it still solvent enough? And so when the company makes extra money at the end of the year, they share part of the profits with customers, what you call bonuses. So customers, policies where customers participate in the profitability are called with profit policies. So you'll always see companies at the end of the year, you'll see companies in the media coming to the public that we have paid this much bonuses to our customers. What that's trying to tell you that you're participating in the profitability of the company. And I'll also talk about the endowments already. Endowments, I've talked of it a lot earlier, but basically endowments also can be also with or without profits. With profits, basically, like earlier said, they still participate in the profitability of the company after valuation of the life fund. Without, basically don't participate. And then there's what we call unit-linked endowment. I think I talked about it earlier when I talked about investment policies, where you have an endowment policy linked with an investment. For example, you'll find part of the premium you pay goes into purchasing what you call unit trusts, which basically purchases the investment element of the life policies. But then you also have what you call more flexible endowment policies, where the terms of the policy are a bit softened. For example, you'll find things like surrender values with lower penalties. You'll find underwriting maybe is reduced, but a more flexible endowment policies. I'll just comment briefly on income protection policies. We also have what you call income protection policies. So basically, what it discovers is that policies also happen that if in case you get disabled and permanently and you're not able to work, that means you're no longer able to earn income. So the policy that you can buy is what you call an income protection policy. It can be as an individual, but then later it can also be bought by a company, what you call a group income protection policy. It's so not common in the market, but it exists. Basically to protect you for the income that you used to earn against the risk of disability. And then finally, I'll talk about maybe group life. Group life policies, you'll be hearing a lot about group life. Individual life, the same principles I've understood in individual life, now we come to group life. So group life policy is usually taken to cover a group of people. So it's usually a master policy purchased usually by the employer, and this policy is one policy arranged on behalf of the employer. So the employer takes it for the benefit of their employees to cover them against the risk of death. It's usually based on what you call a fixed scale, what you call a multiple. For example, it could be 2 years salary of the employer, and all customers will not be required to go for medical. This is so critical, especially in promoting what we call employment retention, but then also to attract employees to your company. So we're seeing companies selling a lot of group life policies. And then finally, I'll talk about superannuation, which I'll also talk about it later. So superannuation basically is retirement. Basically, these are ways in which employers are trying to bring out ways to build for retirement planning, to help to help employees plan for a period after which they are no longer able to work, or even after which they have left the employment with that particular employer. So that's called superannuation, basically building funds for retirement. So I'll go deeper after understanding a bit of individual products. We have understood what group life products are. I'll now go a bit into retirement and retirement planning. And retirement planning is all about, basically is all about building funds to secure old age. You remember the third risk, which we say that as life policies we do face, is the worry of retirement. And we shall be talking a lot about what you call annuities, and that is the discussion we're going to have. So we shall be able to appreciate what is an annuity. We shall be able to also understand how does it work, what are the features, and then how do they work in a market, how are they managed, how are these funds invested, and what are the opportunities we have to be able to sell this and to be able to grow the insurance industry. To enable us to appreciate pensions at strategic level, we need to understand, first of all, how are these schemes funded. Remember, at one time when we have retired at old age, the question is, are we still able to maintain the life that we used to have? That can only be done today by being able to have a discussion on how do we fund that fund to be able to meet that retirement tomorrow. Now, that is what you call funding of pensions or pension schemes. Funding are usually of two types. So funding, they can be what you call funded and unfunded schemes. So funded schemes are schemes which have a method or a methodology of contributing towards building the fund for tomorrow, where retirement income can be drawn from. An example I could give you, for example, is NSSF, for example. NSSF collects 5% from companies, pay 10, and then the employee pays 5%, and that fund is used to build a retirement fund. So when someone retires, NSSF pays that lump sum, and that lump sum can be used to develop, either purchase an annuity, which I'm going to talk about later, or purchase a fund. The other example I give is what you call for superannuation funds. We have seen employers beginning retirement schemes to motivate employees, but also to help build a fund. And that's what you call superannuation. It's a bit also common, but all those are mechanisms of building funds. And then the unfunded one are basically common, so much typical of government pension schemes. And you find that usually in these schemes, they're usually unfunded. You find, for example, in government, when someone retires, money is paid from the consolidated fund. So it's the employer who is government who meets fully the obligations of financing pension for this employee who retires in tomorrow. And how it works is that in their contracts, you find that they're entitled to pensions once they've retired, and on what you call a pre-agreed formula. And that pre-agreed formula can be usually 3 types, can be the average of the earnings during the lifetime that they work. Another principle argued is another school of thought could be the 3 years of the final years that they worked, or the last year that someone worked, so that towards their late twinkle years, those are the period that they expected that salaries were higher and they're able to earn a decent amount, especially on pension. So that formula helps us to compute the benefit that they would earn. So that's what you call funding and unfunding schemes. So that also leads us to what you call defined benefit and defined contribution. So for defined contribution are usually funded schemes, like the example I gave you of NSSF, whereby the employer and employer all come to contribute a fixed amount of money towards funding that scheme. So you have defined contribution amounts for you. Even with superannuation schemes or retirement or what you call provident funds, employers can contribute a percentage, the employee can also contribute a percentage. So you have a defined contribution clearly. You have a percentage of which you contribute towards building that fund. But then also there's what you call defined benefit. So defined benefit, a bit again more common to government schemes. Your benefit is a bit predefined in your contract earlier, and based on a formula, which I just said shortly. The formula can either be the average years of earnings, the final years of earnings, or the last year's earnings. Usually a formula is predetermined. So this is a bit common on unfunded schemes. So you have a defined benefit scheme. Now that leads us to talk about pensions and annuities. So what's a pension? So pension basically is the income paid to an individual after they have retired. So I've worked for 60 years, you've retired and you're no longer able to work, but the continuous money that you continue to earn is what you call a pension. In other words, some people, scholars say it's basically a replacement of the income your salary used to earn. That's in simple terms what you call a pension. So that builds us what you call an annuity. For first timers, annuities is what life insurance helps to answer the worry of retirement. And where it comes from is that usually once people have retired and they have gotten the lump sum of the money, assuming I've retired from NSSF, they'll give you that lump sum, many people can misuse that money. If you look at NSSF reports, I think tell us that about 80% of the people who retire, after getting that money, they've already splashed that money within just 3 years, yet they've worked for a long period of time. So the best way would be by purchasing what you call an annuity. Now, once you've built up a fund, you can be able to purchase an annuity. So annuity is usually bought from life companies, and annuity is basically a contract. It's a contract between the life company and it's a contract between a life company and the insurance company, whereby for a premium you pay, which is what you call the lump sum you inject, the insurance company will agree to pay you periodic payments over time, and based on what you put into the business. Yeah. So that's what we call an annuity, and so they'll pay you regularly over a period of time once you've retired. The person who gets the money is called the annuitant, and the annuitant is a person who money is paid to periodically, and the annuitant gets this money periodically from the insurance company. But then there's also what called deferred period in annuities. deferred period basically is, I would say, for example, if I've retired at 60 and I say I have enough savings right now, I don't need to maybe use that money with the insurance would give me, I could defer this money to the next 5 years or 6 years. So I've deferred the income would expect to earn after some time. So that's what we call deferring of annuities in pensions. Of course, the other question would be asked, critical to also appreciate, is that how would you be able to determine these annuity rates? So these rates are based on a number of factors. The first one being the average age of the annuitants, or the people who have retired. Of course, it's expected that if you retire earlier, if I'm 55 and someone purchased an annuity at 60 years, the one of 55 years paid less, because the one at 60 is assumed to live fewer years. And that's the ideal when we're pricing these policies. The other factor would also be the health. Sometimes you could also be sent definitely for medical examination to ensure your health is worthy of being covered. And the other one also be the economy of the country. If a country has the economy is stable, it also plays a critical factor in determining these rates. If you compare the macroeconomy, maybe of Zimbabwe, for example, if you're designing a pension scheme in an economy where the monetary and fiscal policies are not so stable, that can also be a challenge. And then finally, inflation. Of course, inflation has to be taken care of, because money keeps to lose value over a period of time. Maybe second last, I'll comment briefly on the types of annuities. So annuities have a number of types. The first type is what you call an immediate annuity. So what an immediate annuity does is that, assume I've retired, I've purchased it from a life company, the life company starts to pay me immediately. So if today, for example, today is 28th. If, for example, you've retired today, if you've retired today, payments start immediately the end of this month. So usually they're paid at the end of the period. The same way the company, the individuals pay premium, here now the life company now paying, here is now the life company now paying the annuitant money period. So immediately it starts. So that's what basically it means. Deferred, we have just talked about the deferred annuity. So I don't want to receive my money today. I want to start receiving it after some time. So we say you've deferred your annuity. Of course, that's what we call annuity certain. Annuity certain basically is an annuity to pay periodic payments to the person who has retired, whereby it is certain for a fixed period of time, whether death occurs or not. So that's what you call an annuity certain. Of course, usually in the designing of annuity policies globally, you find they're usually classified into what you call deterministic and what you call life continuity annuity. So deterministic, you have a fixed term. So that's what we call an annuity certain. So if I have an annuity certain of maybe say 10 years, if provided death occurs or not within the term, the policy becomes payable. So that's what we call an annuity certain. And that leads us to what you call also a guaranteed annuity. Of course, the question always customers would ask us is that if I took an annuity policy, assuming I took for 20 years, and I died after 3 years, the question would say, is it fair? You get it? There's always that aspect of being fair. Am I being fair is the insurance company fair to the customer? So what happens is that companies introduce what we call guaranteed annuities to guarantee payments for a fixed period of time, whether death occurs or not. So if I passed away in the 3rd year, yet my policy was guaranteed for 10 years. So I had 7 more years to go. So the company must continue to pay me for the remaining 7 years. So that's the whole reasoning behind it. And then lastly, there's what you call the last survivor. So also couples can be able to purchase life policies as individuals, but then also as couples. If they purchase it as a couple, it's called a joint life policy, where the characteristics of the way companies invest that money should also be very prudent, especially how do they could be things like bonds. One challenge is to take cognizance of inflation, that if I continue to receive this money for a long period of time, is this money still of value over a period of time? So inflation also has to be recognized. And then lastly, liquidity. can the company have money which can easily be convertible to guide? And you find usually the retirement market is guided also by Uganda Retirement Benefits Regulatory Authority regulations. So that's a bit of a summary of the pensions. I think we've been able to understand how these schemes can be funded, how we build up a retirement fund, and what options are there, especially for annuities. We were able to appreciate defined contribution, defined benefits, but then also how do we invest pension funds. So we have been able to appreciate fully all the life different products. So here now we dive a bit to what takes place at the companies, what you call the administration of these policies. So what takes place in administration of this policy? You'll be hearing a lot about underwriting, basically what in IT they call it the interface, the back, what is behind it. So that's what we're going to talk about it into policy documentation. So we find that in life insurance, usually when a customer buys a policy, they're given a proposal form. So basically what a proposal form does is to elicit, we say you elicit information, you collect information, whether general, whether life insurance. So proposal forms have sections, and the first section, they have what you call a general question. They have what you call general and also specific questions. So general questions in the proposal form, you'll find things like the name of the customer, what's the name of the customer, what's the address maybe for the customer, where do they live, maybe what is their medical history, basically the basic things of the customer. But then also specific questions go deep. For example, what's the sum insured of this customer, what's the premium they're going to pay, what is the family history, maybe for particular ailment. So that also takes place. Then, of course, the proposal form also has a section of signature and declaration where I testify and say, I agree that to the terms and conditions of this. We shall also be talking a lot about underwriting. Underwriting basically is assessment of a risk to find out whether an insurance company can be able to accept or not to accept the risk. And if it accepts, what are the options? And if it doesn't accept, what are also the options? So that's usually a preliminary way of collecting information from customers, what you call the initial underwriting, which companies do. Of course, that's not enough. So we also companies go into collecting information from what you call medical forms. So medical forms are usually the information collected. Companies can send us clients to go for medical examination report, what you call the MER, where based on the sum insured, you're required to undergo a number of tests to confirm, again, your health and to see the risk that the company would hold. And then sometimes also, if it's specific, if the company is interested in investigating a particular ailment, maybe stated in your proposal form, we can request what you call a general practitioner's report, where I ask for a report from your particular doctor who you always go to attend to be able to provide for us a particular information that we're interested in. But then that is not enough. The other documentation which is critical is what you call questionnaires. And questionnaires can either be occupational and then also financial. Occupational questionnaires are basically to ascertain the risk of exposure of my occupation and how it does impact on the policy that I've bought. And then financial questionnaires are usually bought to achieve usually key two objectives. One is to determine the affordability of the policy. Assuming I earn a salary of $1 million and I'm buying a policy where I'm paying $5 million a month, you see, there's no clear relationship between how much I earn and the policy I pay. Am I overbuying? Is it really affordable? But then also to eliminate what we call a moral hazard. Some people buy policies for the sake of creating a moral hazard, and so that also helps us to investigate, especially where there's what you call anti-selection. If, for example, I know that the company has a medical limit, assuming that for anyone who buys policies exceeding 30 million, they are required to go for medical examination. So I go and buy 3 policies of 10 million. So you can see that's what you call anti-selection. So that I buy small policies to dodge the underwriting of this company. So that's what you call anti-selection. And then finally, we shall issue the policy document, basically which describes the terms and conditions of the policy. It will have what you call a schedule, a summary of the premium, what is covered, riders included, but then also conditions of the policy, exclusions, and then finally endorsements also come during the term of the policy, because as the policy runs, customers may want to increase their premium, maybe because they've earned more income, but then also too, there could be children of beneficiaries that they would want to add. So that's basically a summary of the key documentation involved in life policies. I'll comment briefly on still on the administration. So underwriting. So underwriting, basically, we say it's a process of assessing this life to see whether we're able to cover, and if we are able to cover, how are we going to be able to cover that life. So what is very critical here is that companies use what you call a number of factors to base on. The first one is what you call the age. So in the proposal form, you could look at the age of the person. It gives us a picture of the probability of loss that could occur based on the mortality rate. The other thing is what you call the body mass index. In the proposal form, the body mass index basically is the ratio of your weight and height. So if, for example, your body mass index is in the ratio of 18 to 25, we say you have you're normal, and therefore you're not susceptible to maybe pressure. But if your body mass index is between, let me say, 25 to 30, you have a higher probability of being obese, and therefore you could be a potential risk. But if my body mass index, for example, exceeds 30, it basically means I'm totally obese. So the company it's a critical thing for the company to investigate. Like earlier said, the initial underwriting is basically the proposal form and the information that you provide. And however, deeper underwriting, the company could go to ask you to provide medical reports and questionnaires that have already provided. So from the information you give us, the company is able to classify the risks. So the risk can either be standard. Standard risk basically says that for a life age X, assuming someone age 30, that his exposure matches the probability that he lives or he will die will match our mortality experience. So that life, it would increasing, you could have what you call an increasing risk. Maybe I have a chronic illness, for example, that this chronic illness, I be expected to worsen over time. So that becomes an increasing risk. But the risk also could be constant. For example, I have an occupation where I do the same thing daily. So that's a constant risk. But also the risk could be decreasing, especially where I'm undergoing treatment or what you call prognosis. So that's how I would classify this risk. And after classifying the risk, the insurance company can be able to make a decision. If my risk is standard, they'll just charge normal premium. If my risk is increasing, then they could load me the premium or increase a special term by increasing it by a small percentage to recognize the increase in risk. But if the risk is decreasing, I could load by a small percent that reduces over time, because after 3 years, it's expected that maybe I've fully recovered. And then, of course, if my risk is really bad and I cannot be accepted, definitely the company can decline. And therefore, maybe we give other options to the customers. And then sometimes also postponed, especially if someone, for example, is ladies, for example, someone's, for example, pregnant, we can postpone the policy until the time when they're able to, when they've given birth, and then cover can commence. I'll comment briefly on reinsurance. So that's a bit of underwriting. In regard to reinsurance basically insurance to cover the insurance company. So it's basically a contract between the reinsurance company and the reinsurance company to protect the insurance company against certain risks that they think they cannot be able to bear on their own. Insurance companies will always have what you call a retention, things which they can cover, but anything beyond their retention, they will pass that risk to what you call a reinsurance company. And reinsurance companies do help companies, especially reinsurance companies, against one, risks that one, they wouldn't be able to cover, but then also two, catastrophic risks. Assuming you have a risk that wipes away an entire industry. Look at what we're having today, for example, of COVID. COVID is really catastrophe. It has affected the whole world. But then also the other thing is it also helps smoothen their profits, especially in their financials, to avoid huge exposures. And reinsurance is really classified into two. We have what you call treaty reinsurance, and then there is what we also call a facultative reinsurance. So treaty reinsurance basically is an arrangement between the company and the reinsurance company, where the insurance company cedes or passes over certain risks they cannot bear to the reinsurance company based on terms and set conditions. So usually it's on all the risks, and they usually do this based on the treaties that they do have. Number two is facultative reinsurance is basically insurance that covers reinsurance to protect insurance companies against things that are already excluded in their treaties. And it helps really insurance companies, especially for things that were not covered. So companies can go and buy facultative reinsurance covers to help protect them. All things which they cannot hold fully on their balance sheet. So that's where facultative reinsurance plays a critical role. Maybe I'll comment briefly into also how risks are shared. So risks can be shared proportionally or non-proportionally. So proportionally, basically, we're saying that the reinsurance company and the insurance company agree to share the losses or the risks based on a certain proportion of premium and also claims. So for example, the insurance company could take 10%, the reinsurance company could take 90%. So they agree a fixed proportion. And then non-proportion is basically the opposite. They don't agree to share any fixed proportion. The common example there is what you call an excess of loss, for example. Very common in general insurance, where I would say over and above the excess, I will cover, the reinsurance comes to cover. But anything below that retention, the insurance company is expected to bear that. And then finally, I'd already talked about valuation, that companies do what you call actuarial life valuation. And this is basically done at the end of the year, where companies are expected to do valuation with life fund. It's also a regulatory requirement, especially for life companies, want to determine the health, the financial health of these companies. So people who do that are called actuaries, and they're basically financial engineers who assess the solvency of these companies. And they're able to tell us where the company has been able to make profits at the end of the year. And in case they've made a surplus, that surplus can either be distributed to customers as bonuses, what you call simple bonuses. And these are basically declared as a percentage of the sum assured periodically over a period of time. And then also at maturity, there's also what you call terminal bonuses. When policies do mature, they are also added to the policy. But even if there's a surplus, the company is not meant to eat all the money. The same thing with us as individuals. When you have extra money, don't eat the money all. Use that money for the rainy day. So they'll keep part of that money into what you call reserves. Reserves basically is money they put aside to meet future obligations, future claims. There could be already claims running, but not, maybe investigations are not even concluded. But there are also future emergency claims, which we don't know when they could occur. And then finally, dividends. Of course, the shareholders are the owners of these companies. It's expected that they would also want to be paid their profits at the end of the year. So that's basically a summary of underwriting, reinsurance, a bit of the life industry, and a bit of valuation of life fund. I'll just add something to do with also policy administration. I'll be talking about the what you call claims. Definitely claims occur also in the insurance industry. So in the claims, basically, we have understood fully how life insurance works. So we now also need to be cognizant of that claims can occur. So as soon as a claim occurs, it's just what the client needs to do, or the agent is, or the broker is to notify the company. The first thing the company is to do, will always do, is to check whether the policy was in force. The enforced means where all the premiums paid. We always will ask for the policy document, and sometimes also proof of death. So we always, the company always asks for the death certificate issued by the government, but then also proof of age, especially if the age was not earlier admitted at commencement of the policy. Of course, also can ask for proof of title of the beneficiaries. If you're a spouse, for example, you could ask maybe for your marriage certificate that you're actually a spouse to this couple. So there are about 6 main claims in life. The first one is death claims, which I've just talked about. And someone dies, and for the documentation you provide there, basically is the policy document will be required, but then also they'll need the death certificate. If the person died in a hospital, we could ask for the last attendance medical report could be asked for. If he died at home in the village, again, we try to keep the documentation simple. If it's someone died home, maybe an LC letter could also support, but that's a bit of a summary of death claim. As soon as the claim occurs, just notify the insurance company. The last expense is usually paid within 24 hours. Some companies do 48 hours, but the idea is that that money should be able to help the clients. Then we have also critical illness claims. I already talked about critical illness earlier. If you're diagnosed, what they'll need here is basically the report from the doctor, And also it's important that the critical illness should have occurred that year, and it was not a pre-existing or an earlier excluded disease. I already talked about permanent, total permanent disability. Definitely, again, the doctor's report helps here. It's critical before the payment is done. Then, of course, policies also will mature. When policies mature 3 months before for planning, then they'll give a customer a discharge voucher, which they'll complete, and then the claim will be paid, of course, with the policy document. And then lastly, reinsurance claims. That quarterly reinsurance and insurance companies do reconciliation where they pay the companies back on the claims which had been reinsured. I'll just comment briefly on what you call also forfeiture of the conditions of the policy. You find that the fact that life policies are also, the fact that life policies are long-term, there's also a possibility that sometimes policies may not reach their maturity. So that's what we call forfeiting of policies before they reach maturity. And certain things can be payable. So in forfeiture, we have about 5. The first one is what you call surrender value. So a policy can have a surrender value. And surrender value is only provided once a policy has run for 3 years, the policy being paid to date, and then the surrender value is paid to the customer. Of course, the surrender value cannot be equal to the premium paid. It takes into cognizance of the expenses incurred by the company, which also the company has to take away or recognize those costs. The other aspect would be what you call the policy loan. So loans can also be advanced on life policies, and usually based on percentage. Different companies have different pricing, and usually it's a percentage. Some companies do between 75 to about 90%. Of course, there's the third non-forfeiture condition is what you call a policy loan. So the policy loan I've talked about. The third one is what you call a premium loan. So usually provided policies do have a surrender value, a company can be able to advance premium to the customer to keep the policy in force. Of course, the condition is that the advance should not exceed the surrender value and any interest which would be attributable payable. And then finally is what you call the paid up policy. So a policy is said to be paid up, assuming that I take a policy and after 4 years, I say I can no longer be able to finance the policy, but I don't want to cash out or withdraw away from the policy. So your policy can be made paid up. Basically, your sum insured will reduce to recognize the period that the policy has run. So finally, we shall end with, after understanding fully life insurance from history, from products to underwriting, to marketing, to policy administration, it's also important that we end up with what you call new developments, especially within the life segment. These are global trends which we cannot ignore, but are also important for the industry, but also important for our knowledge. So key emerging things we shall talk briefly is we shall talk briefly on microinsurance. I'll comment briefly on bancassurance, and then also Takaful, and then we shall be able now to respond to questions raised. So the first one is microinsurance. So microinsurance is simple. It's basically insurance meant for the low-income earners, or insurance and the usual of low premium, and for people who for a long period of time we had excluded from the traditional insurance. So the usual of low income, and so much common with credit life policies. Personal accidents and also funeral, very common, especially insurance meant for the low income. And we believe that this can help us grow the insurance sector. I'll talk briefly on bancassurance. Basically, bancassurance is a new norm in the industry today, and basically it follows the passing of the Financial Institutions Act of 2016. That government introduced bancassurance, Islamic banking, and Takaful. Again, this government here is trying ways to grow the financial sector, which had been fixed for a long period of time, to help us grow. And bancassurance also came as a mechanism to help grow. Usually runs basically on 2 models, on what you call an integrated and a non-integrated model. Integrated model, basically here, what the insurance does and the bank is fully integrated. You'll find, for example, the bank would sell insurance on behalf of the insurance company. The bank, for example, would collect premium for the company. They would agree to share premium together. And then the second one basically is the non-integrated model, which is basically the opposite. So the insurance, the bank does not have any integration with the bank, but they could even have the independent financial advisors who sell, especially to third parties, insurance. Of course, the benefits are enormous. Benefits include things like to the bank, for example, the bank earns income. The bank has been able to optimize its customer base and provide a lot of attraction also to its customers, to give more options to the customer, but also to become one-stop center of selling. So I've seen bancassurance grow. I think the first year of operation it has really grown, and it's projected that it could be a critical transformation for the insurance industry. And then finally, of course, insurers will grow. They're able to increase their income. Insurers are able to also have innovative products will help us to grow the industry. And then finally, Takaful. Takaful basically is insurance that follows the law of Islam. Of course, we know in Islam, traditional, there's what you call haram. Basically, three things. There's what you call gara. Gara basically is, these are things which are forbidden by Islamic principles. So things like interest, gambling, things to do with interest, gambling, uncertainty. Uncertainty basically is gara. These are basically things which are forbidden. So you find that now insurance has to remodel into a way of recognizing the principle of Islam. And how that is done is that through Takaful, is that the principle will include things to do with, for example, a fund. It's usually a fund that these members contribute, what you call as we call it, contributions, and they'll share losses from this fund. Also, they'll share gains from this fund. At the end, they're more of brothers keepers, you would say, in this fund, and they were able to eliminate the aspect of uncertainty. So basically, that's a brief here. So that brings basically my end to key highlights into life insurance at broad level, from history to operations to marketing to claims to policy documentation to valuation into emerging issues. This brings me basically to the end of my presentation. Yeah.
For ably handling that part of the presentation. We are now going to go into the questions. Now, I need to alert members that we have had almost 110 participants for this session. So it is not possible that we would be able to handle all the questions at this moment. So we're just going to select a few which Joshua will respond to, and then the rest of the questions, we are now planning a Q&A session on Monday. We shall be able to communicate. It means you'll keep your questions coming, because we'll have a Q&A session on Monday, which we are going to dedicate to simply question answering and handling. So I would want to go straight into the questions that have been raised. Joshua, allow me to forward about 3 questions. You handle them, and then we go into another 3. I hope that is okay with you. Question number 1. How can someone apply for a loan after saving for 3 years? That has to do with the policy loans. Joshua, you note that it's an aspect of the policy loan that you need to listen. Is what are the characteristics of a successful life assurance salesperson? You talked about the sales cycle, Joshua. So they want to know, or the participants want to know, the characteristics of a successful life assurance salesperson. The other question is more of a scenario, and the comment is, what advice do we offer to a client who has been saving for more than 1 year and is not willing to continue with the policy? What advice would you give a client who has been saving for more than 1 year and is not willing to continue with the policy? Joshua, I request that you take those first, and then we'll go into the next 3 or 4. Ronnie, can you allow Joshua to respond to the questions, please?
Okay. Yeah, Jonah, can you hear me?
Yes, please. Proceed, Joshua.
Yeah, thanks. And thanks for the question. I think I'll dive straight to what has been raised. The first question is that what are the conditions for applying for a loan after the policy has run for 3 years?
Yes.
And my comment there is basically, that the way the non-forfeiture condition works is that once a policy has run for 3 years, a customer can be able to apply for a loan. And where this comes from is that we understand that life policies are long-term, and customers can have challenges during the period. Maybe it's education, maybe it's an emergency, maybe health. So they usually apply for a loan, and how it works is once a policy runs for 3 years, you write to the life company, and the life company is able to advise you of the loan amount. So how it works is that the company first computes what you call the surrender value of the policy, and the loan is a proportion of the surrender value of the policy. So for example, if my surrender value is maybe 2 million, the loan could be 75% of the 2 million. So that's how it works. Into computing, maybe the technicalities, I may not go into that, but basically a number of factors are considered that one, the customer should have been paid to date, and assuming if I've paid for 3 years, but remember my policy was to run for 10 years. So the company one determines what you call the paid up sum insured, which is basically the proportion of the year that I'm in, which would be 3 out of 10, the proportion I'm in, times what you call the surrender value factor, which basically is to recognize the expenses incurred by life office. So that's typically how it works. So of course, it's not free. You realize that definitely the loan will also be less than the surrender value. And why? Your life policy still remains running. So if this customer died tomorrow, the insurance company will pay the full benefit less the outstanding loan balance. And companies will want companies also will want the customer to pay the loan with interest. So the interest is really manageable, typically 14–15%, but again varies with companies, and they pay the premium periodically with the loan. They can sign a standing order to pay both the premium. I hope that can answer much better. I'll go. Yes. Yes. I'm going to. The second question was raised by, I think, a participant of what makes a successful salesperson, if I do remember. And Rem initially had already highlighted key things which involve the sales cycle. And just to help us, what makes successful salesperson about? I think I would pick about 4 key things for you. One is, remember we say that agents have to act with duty and skill. So for you to have duty and skill, it basically means you have to have product knowledge. So you have to understand your product deep in, out, understand how your product is, what are the features, what are the terms of this policy. If your unit leader cannot explain, engage someone higher until you understand this customer. Because you see, insurance is sold by trust. Till you understand that policy is the best way of being able to sell. You remember, you become a subject matter when you've understood. So that's the first step for me, is product and knowledge of the policy. The second one, I would say interpersonal skills. Interpersonal skills involve a number of things. Interpersonal skills will be your presentation skills, your outlook skills, your personal branding, how you engage, how you talk, and how you present yourself. I think if you went to meet a customer, interpersonal skills will carry a lot, and I cannot say this is how you should do it. It varies a lot from people, how you conduct yourself. The third one, maybe I'll add, is what skills. I think this customer, if the customer call back on your customer after only closing, even after closing, you still work with the customers. Successful salespeople, people who understand product, interpersonal skills, communication, then finally, sales services. Don't abandon customers, members. Today, you don't even check on the customer on their birthday. You don't even call the customer after 6 months. It's not good, because if you manage this customer, they're able to refer you to other customers. For me, that's what I would pick out as for great customer selling. And I think lastly, what would you advise someone who has only had a policy saved for 1 year and is unwilling to continue? This is a tough one, really. And remember, life insurance is a contract. And we need to remind you, the team, is that a contract has terms and conditions. If you don't oblige, reasons why someone may say, is it fair, is it not fair? There are reasons which lead to that. Remember, I told you that life policies are very sensitive. Just imagine a customer paid 100,000 in one month and died after a month. I'm going to pay 10 million to the family. So the risk exposure is high. And the main reason as to why nothing is payable is that these companies have high loss expense in the earlier years of the policy, which cannot be recouped back, yet the risk is so high. But my advice would be either we could put the policy on hold for some time when they have been stabilized. The other option could be to discuss whether maybe reducing the premium. Maybe I was paying 100, can I reduce it to 50? I have to try ways of discussing, but that should be an open discussion where it's transparent between you and the company. But those could be the options, available. Yeah.
Thank you, Joshua. We'll go into the next set of questions. I think those are quite clear. We have got Ochana and Laura online who want you to explain a bit more about endowments and unit trusts. Probably maybe you could go into a bit of types of endowments, but just give a bit of an explanation on endowments and unit trusts. We also have Geoffrey here. Geoffrey has come up with a very interesting scenario. He's saying that if a client's policy lapsed after paying for 2 months, the client now returns after 10 months and want to pay the outstanding premium by paying double the amount they were paying previously. How would you handle that situation as an underwriter if that client comes to you? The client's policy has lapsed after, of course, paying 2 premiums or 2 installments for 2 months, basically. The policy will definitely lapse, but the client returns after 10 months and now would want to pay double the amount of premium they were paying. How would you handle that scenario? I think, Joshua, you can take those 2, and then we'll come back and go into the final set of questions. Ronnie, you need to let Joshua access, unmute, please. Ronnie, unmute Joshua.
Okay, yes, thanks. I think the first question, someone wants to understand a brief of endowment and the unit trust endowment policy.
Just a bit more.
Yeah, I just make it simple. Endowment policies are typically savings policies, common more in the market, and they have 2 main key aspects. One is that they cover the client in case risk occurs during the term of the policy, so which basically is protection. So if nothing occurs at maturity, at the end of the policy, the policy pays a maturity benefit. So the sum assured is paid to the client at maturity, plus what you call bonuses. It has 2 critical benefits. One is protection of the risk which occurs. Number 2, it also provides a savings, it acts as a savings tool to you. So after maturity, you have this lump sum paid to you. Now it has what you call bonuses, and where the bonuses come from is that, remember we had said that endowment policies can be with profit or without profit. So with profits, basically, these are whereby policies participate in the profitability of the company. And we said that earlier when at the end of the year, companies do valuation relying by an actuary. So if at the end of the year, the actuary has realized that the company had a surplus, part of that surplus goes into bonuses, what you call simple reversionary bonuses, and a percentage of that is accrued to the customer periodically per year. Then also at maturity, we also pay what you call terminal bonuses. The other part I wanted to comment on is that for I think you also asked about endowment and how does the unit-linked endowment work, is that remember we said that life policies are of 3 types. There was protection, there was savings, and investments. So unit-linked brings the aspects of investment. So it's not so common in our market, but in other markets it is, for example, in Kenya. And how it works is that if, for example, you find that the premium the customer pays has an aspect of life protection, has an aspect of savings, but also has an aspect of investments. So for example, if my premium is 100,000, you might find that 10% or 20% of that money is put into what you call a unit trust. So unit trusts are investments, what you call collective investment, so a pool of collective investment. So part of that money goes into purchase of what you call a unit trust, where at the end of the period, I also earn interest. So overall, in the pricing of the policy, you have the life aspect of the protection and the savings, but then also the unit trust brings the element of the investment arm of the return in premium. That's a typical model of how a unit of a unit-linked endowment policy. So you find the premium is linked to an investment element of a unit trust. So you find even this company, life company, will have to work so much with the investment arm. That's why you find these life companies have a lot of the investments. The second question, I think, is someone asked the question of a customer has paid for 2 months and then has stopped paying, then comes back after 8 months, about 10 months, but wants to double 10 months, wants to double payment. Yes, of course,
early in the policy, we say this policy has terms and conditions. The first thing in under non-forfeiture, we talked about policy lapsing. Remember, policy lapses after 3 months. If you look at the third month of the third month, this policy had already lapsed. So if a policy lapses, the first thing to do is to clear all the outstanding premium. But again, if you take long, most companies, if you exceed the year, the customer will be requested also to undergo medical examination, or he may be required to complete what you call a declaration of good health to tell us that his state of health has not changed since he was. So if he has cleared the outstanding, then he maybe wants to double its premium. That is okay. Remember we said policies can be endorsed because people have income increasing during the period. So that can be done. But remember, we can't do that on a lapse policy. First, we have to reinstate the policy, and then we can now revise the policy upwards by a premium going up, but recognizing also the pricing of the policy. In other words, we need first stick to the terms of the conditions, first reinstate the policy, and then we can endorse the policy to recognize the increase in income. I think that's a typical operational model. Yeah.
Okay, thank you, Joshua. The next set of questions coming through here, we have Anne, Moses, and I think Nicholas, who wants some clarity on annuities, and they're asking, Moses says, are all Provident Fund payments converted to an annuity? You will note that, okay? Or someone can get a lump sum. I know you addressed that, but you can throw more light on it. Then the other question is, are annuities paid once? Again, that is because I want to take the annuity questions together so that you can then be able to respond. And then how does age affect annuities? So we have 3 questions on annuities. We're talking about the aspect of payment of a lump sum or paying an annuity in case of a Provident Fund payment, but also, are they paid once? And also, how does age affect annuities? The other question from Ochana was about unit trusts. So you'll also throw a bit of light on unit trusts. And I'm going to request that we will allow another set of 3 questions and then we close the session. So you can take those, then I will do another set of 3 questions and we'll close the session. Ronnie, allow Joshua to take the questions, please. Ronnie Balimonsi, our host.
Okay, yeah, thanks, Jonathan. I dive straight to, let's start with the annuity question. The first one is that can all Provident Funds be converted into annuity? And I want to again guide here is that annuities in Uganda, again, you have to first appreciate the legislative framework within the pensions industry. In Uganda, you realize that annuities are not compulsory. Some time back, government stakeholders are trying to engage on liberalization of the pension sector, and the hope was that it would be mandatory that once someone has retired, 2/3 of the income, if, for example, you got your lump sum from NSSF, it was mandatory that you purchase an annuity, but the law was not passed. So in Uganda, it's still a liberal market. In other advanced markets, that's the practice. In Kenya, in most advanced markets. But I need to guide here. Remember, we said that pension annuities is more of a pension, sustaining pension once you're retired, paid by a life company. And also, the question I was trying to raise is how do we fund retirement? How do you return money for retirement? I gave examples. One of the ways of funding is by contribution. You gave a good example, Provident Fund, where an employee and the employer possibly contribute money to the fund. Now, once they give you the money, unfortunately, it's you now to make the decision. The employer now cannot force you, or the government cannot now force you to go and purchase an annuity. Now, it's because it's a liberalized economy. So now when you get that lump sum, if you get that lump sum, if you think you've built part of your fund, maybe from NSSF, a Provident Fund, or other voluntary Provident Funds within the industry, you can now, you as the person, you are the one to take the responsibility to go and purchase that annuity from a life company. The company can't force you because the laws of our land don't allow that. But I encourage you to purchase that. That would be a better decision. The second part is that can annuities be paid once? Can they be paid more frequently? Yes. Yes, annuities can be paid once or even more frequently. There are practices of quarterly or 6 months, but the most practice is actually annual. Someone gets a lump sum of money, puts it into, gives a life company, and the life company is able to give a particular type of annuity, which depends. So, and if you realize one of the factors that also affect annuity computations is what you call the fund that you contribute. If I put more money, my benefit also also is higher. So my comment there is that it can be paid once or more quarterly. The annuity, there are so many types. Some run for a fixed period of time, some run for longer periods of time. We also can have a life annuity running for the whole of life. So yes, it can be paid more than once. However, the most ideal practice that companies have adopted is a lump sum payment. I get a lump sum today and take to the company, and they're able to determine an annuity amount payable to me, and also the different type applicable, whether it's an immediate annuity where you receive the money immediately, or maybe whether it's a deferred, maybe later, maybe if it's an annuity certain or guaranteed dependingly. Maybe finally, my comment, the person on the age, yes, and how does age affect annuity pricing? Well, thanks for that's a very good question. And remember, we said a number of factors affect how pricing of annuities is done. And why age is critical is that you see, in life insurance, we say the higher you live, the probability of death goes higher. So what does that mean? For annuities, the prayer of the insurance company is that this guy should not live for so long. Are you seeing? So this guy shouldn't live for so long, benefits the insurance company. Because if he lives for so long, the insurance company must continue paying for a long period of time. And that's the challenge you're seeing in Europe and the world today, where people in Europe, for example, are living long. So companies continue paying a lot of liabilities. Now, because of that factor, if you're younger, if someone who is 55, for example, someone who is 55 is assumed to have a higher life years to live compared to someone who is 70. So if someone of 70 went to purchase a life annuity product, remember he has 30 years to live only, approximately, assuming he lived to 100 years. But you is 55, you have a problem of living more 50 years. So because you're younger, your annuity payment gets less, and that is basically the reasoning in the pricing. Because that is basically the reasoning. So the younger you are, the age, the higher, the less annuity, the less the annuity amount that you get. That's basically the understanding when they're pricing. But the other factor also is that when companies are investing these funds, they always also look at what's the average age of an economy. If I look at Uganda, what's the expectancy rate, for example, for men, or for what's the life expectancy for men and for women? If, for example, I think currently it has much improved, about 53 to 55 years. If the average life expectancy in Uganda is 55 years, so it means if I'm an actuary and I'm designing this life annuity factor, I have to take into that the cognizance of the country's mortality experience. So that's also a factor. But then when I come to, if I'm a company, I'm investing the funds. If I'm a fund manager and I have 100 annuitants, what is the average age of all these annuitants? If the average age is 45 to 50, what do I project as being the longevity of these people living long? So those are some of that's how age impacts. Age impacts in terms of pricing, in terms of the younger you are, the less you get, but then also impacts in terms of also the life expectancy of a country in pricing. But then finally also, it also impacts to the investment arm. How do they invest money in terms of the average age of the pension fund? That also is critical. Lastly, on the unit trust, I'll go very fast. A unit trust, basically, these are investments and are usually run by investment companies. They're not run by life companies. Life companies only link the life product to a unit-linked product. So these are typically run by investment companies, and the idea is basically to encourage people to save. One of the challenges is also just a mechanism of savings, the same way life is. It's a typical investment product, and they're usually run by investment companies. In companies, you'll hear ICA Life, you'll hear UAP, you'll hear Jubilee, you'll hear the Stanlib, you'll hear a lot of the investment companies. I'll talk about that. And unit trusts are usually of two types. Unit trusts are of what you call a balanced fund, and there's what you call a money market fund. And unit trusts recognize two very interesting components of investors. The investors who fear risk, the investors who don't fear risk. So for investors who fear risk, they always want their money certain. Since they want their money certain, most of them go to buy what you call a money market. So a money market, typically, you could decide to pay maybe 100,000 a month. Minimum, I think, is 50,000. You could pay maybe 100,000 a month periodically, and annually you earn interest. Now, the beauty with it is that if I could put 100,000 in, let me say, ICA, for example, we could be like 1,000 people contributing 100,000. So you're pulling so many people. So the investment company has a lot of money. They're able now to negotiate special interest from banks, special interest from return on bonds. So that's the advantage you enjoy by being part of a group. So it's about pooling of funds. Now, because you remember, for you, you're a short-term investor, maybe you want that money in 1 year. So if you want your money in 1 year, the investment company must ensure that they have liquidity, so they'll invest in low risk assets. And I think it allows you one withdraw a month. So you're able to withdraw money once a month. It's very simple. If you want money, you just drop an email to the company, you fill a form, they transfer money to you within a day. And then the second category is what you call a balance fund. Now, the balance fund is for investors who fear risk. Yeah. So this is good for people who want to invest more. Like I would advise you to invest here if you want to invest for more than 3 years. So you find a bigger percentage of this money is put in more into higher risk investment elements, things like shares, a bit of higher risk. But the bit about it, the return could be very high, but also it could fall. Yeah. But the beauty is that your investment advisor, which is investment, will always give you guidance. Will always give you periodic information. For example, monthly, they'll give you reports on the happenings of the economy, on the investments, on the performance of East Africa global markets. So they'll always guide you. But that's how typically unit trusts work. It's basically savings, and you can buy it just it's a minimum of 50,000. Yeah.
Thank you, Joshua. Now, finally, and very important, I know we are running out of time, and I will request you to use just 1 minute. The impact of COVID on life insurance. The impact of this pandemic on life insurance in terms of pricing, in terms of lapse sessions, in terms of the impact. This has come out strongly. I think the impact is going to be life insurance. Ronnie, allow Joshua to take the question, please. Ronnie, allow Joshua to take the question. The impact of COVID on life insurance on the market.
Yeah, and thanks, Jonah. And that's a very good question, very brilliant question, especially taking cognizance of the current trends happening globally. Very good question. And it's a big question. For a long period of time, insurers used to have exclusions on pandemics. But you see, with life insurance is different. Life insurance, the question would be, life insurance, what are we covering? We're covering death, yeah? The risk. So when a death comes from an accident, whether death comes from ulcer, death is death. So we are seeing insurers actually covering that. But for a long period of time, insurers used to exclude what you call pandemics. But pandemics, especially in general insurance, for example, pandemics that saw the whole world, and for a long period of time, reinsurers have been excluding. I was reading, I think, on about 2 weeks ago, there was an article written by BBC in UK, where the Lloyd's market had indicated that the insurance industry was going to be hard hit by about 80% claims for the next 2 quarters, especially on the impact of business interruption. So that was so interesting. So in terms of pandemics, for a long period was excluded, but also it's also a tough question for the insurance industry, something which we were not prepared for. I remember it was unexpected. This is going to have been something new. For life insurance, I think for right now, most of insurers are paying claims. I've seen no one has excluded, no one is excluding claims coming out of pandemic. Actually, we are seeing insurers becoming more innovative and taking a rare part of their social responsibility, recognizing that if a customer died out of any of COVID, they would pay. Certain companies, I think even Prudential, have gone a step further to give even hospital cash allowances. If, for example, I'm diagnosed as suffering from COVID, even I think paying a daily maintenance amount of 100,000 per day up to a maximum of 30 days. So I think insurance actually paid. The other key question is there's a bit of still argument on the impact of COVID and business interruption. The question, of course, naturally, insurers for a long period of time would exclude pandemics, because you see, pandemics affect the whole world. Pandemics affect everyone. And it's expected that pandemics are usually covered by global networks, by the UN, the World Health Organization, the world coming together. The same thing we have seen COVID, the world coming together. But for right now, I think insurers are covered. Insurers are paying actually claims for COVID. No one's excluding that for life. The only the discussion, which is still undergoing a tough one, is the impact on business interruption, especially for general insurance. I think that's a tough discussion, but I think it's also a political discussion. In markets like Europe, I've seen, for example, in UK, the Financial Conduct Authority has gone ahead actually to dictate. They've actually forced insurers to pay claims arising out of anything to do with pandemic. So they're tough questions, really. And if it's the government directs, these are quite tough measures. So in UK, I've seen Financial Conduct Authority about 2 weeks ago directed actually the industry to pay any claim arising out of pandemics. It's quite tough, but it will be also a big hit for the industry, especially this year. Yeah. But I think it's also a lesson for the industry. I think also it will also enable us learn. We all there's always a learning phase. Remember, the world was hit previously by catastrophic events like floods. The world was hit by hurricanes, and we saw insurers coming together, pulling together funds, even government putting money into those funds. Water, the flooding, remember the issue in Australia about the fires. We're seeing different economies coming together to be able to address and share and cushion some of those risks. So it's a great learning lesson, and I think we hope a vaccine is got as soon as possible, but it's a quick, big challenge for the market. Yeah, I think that would be my take. Yeah.
Thank you so much, Joshua. I have so many comments regarding your presentation. Many of our participants have commended the good job that you have done. So allow me to thank you on their behalf, and also to thank my other colleagues who have been on standby, Ronnie Balimunsi and the rest of the Insurance Training College team that has also been on standby and assisting. Remember, like I mentioned, we are running these webinars daily. Tomorrow, we will have general insurance practice, same time 10 to 12 midday. And then on Friday, we expect to run 2 webinars. That is bank assurance and professional selling skills. Now, someone asked, what are the characteristics of a successful salesperson? So professional selling skills is one of those that you need to attend on Friday, so that you can then be able to pick out some of these skills that will make you a successful salesperson. Now, remember, like I mentioned, on a Monday, we would want to run a Q&A session. Now, this Q&A session will communicate the time, but please keep your questions coming on training department at iiu.ac.ug. Now, we are going to take these questions before, such that by the time we dive into the session on Monday, the tutors are just on hand to respond to those questions. Please keep the questions coming all through. The other thing I want to emphasize is that the link is going to be available. Now, for yesterday's presentation or session for fundamentals of insurance, you can go to our website and download the presentation. And also, if you would want to listen in, the recording is available. So that yesterday's session is already available on our website. Today's session will also be up and running on the website. So many of you have been asking, how do we access the presentation? How do we access this information? This is going to be on the website. Remember, on Tuesday, we have engineering. We have our tutor from Singapore who is going to be taking us through COVID-19 and its impact on engineering insurance. Be sure to book your slot on Tuesday. So from me here in Wakiso, I've been Jonan Chisache, your host, together with Mr. Ronnie Balimunsi, wishing you a wonderful rest of the day and saying, let's see you tomorrow. We shall begin right on time, 10 o'clock tomorrow, Thursday, this very month.